A government wakes up on Monday morning short of money. Tax revenue is weak. Markets are nervous. Bills are due. Salaries must be paid. Debt is maturing. By Tuesday afternoon, billions of new dollars exist that did not exist the day before. No printing presses roaring. No trucks of cash rolling out of central bank basements. No dramatic stacks of freshly inked notes. Just numbers, quietly typed into existence. And that's where most people get it wrong. Because when a country prints money, almost nothing you imagine actually happens. And what does happen is far more powerful. Right now, governments around the world are running record debt. Central banks have expanded their balance sheets to levels that would have sounded insane 20 years ago. The phrase, money printing, gets thrown around every time inflation rises or markets panic. But if you don't understand what really happens in that moment, you don't understand modern power. So let's slow this down. Step 1. The government needs money. Governments don't literally create money themselves. They spend by issuing bonds. A bond is just an IOU. Lend me money today, I'll pay you back later with interest. Normally, investors buy those bonds. Pension funds, banks, insurance companies, foreign governments. But sometimes investors don't want enough of them. Or they demand very high interest rates. That's when the central bank enters. The central bank is not the government. It's technically separate. In the United States, it's the Federal Reserve. In India, it's the Reserve Bank of India. In Europe, the European Central Bank. And here's the key. The central bank has the power to create bank reserves. Not cash. Reserves. Reserves are digital balances that commercial banks hold at the central bank. They're the plumbing of the financial system. You don't see them. You can't spend them at a grocery store. But they are real money inside the banking system. Now imagine this. The government issues $100 billion in bonds. Investors hesitate. The central bank steps in and says, fine. We'll buy them. But how does it pay? It doesn't take money from taxpayers. It doesn't borrow from someone else. It simply marks up the reserve account of a commercial bank. The bank now has $100 billion more in reserves. The central bank now owns $100 billion in government bonds. New money has been created. No printing press. Just a balance sheet expansion. This is called quantitative easing. It became famous after 2008. It exploded in 2020. But here's the uncomfortable part. That new money does not go directly into your pocket. It goes into the banking system. The bank that sold the bond now has more reserves. What can it do with them? Technically, banks don't lend reserves to the public. They lend based on capital rules and demand. But higher reserves make the system more liquid, more comfortable, more willing to lend. So asset prices rise, stocks rise, real estate rises, bond yields fall. People holding financial assets feel richer. People without assets mostly feel nothing, at first. This is where the hype versus reality split happens. The hype says, the government printed trillions. Hyperinflation is coming tomorrow. The reality is slower, more mechanical. Inflation doesn't appear just because reserves increase. It appears when money chases goods and services in the real economy. If banks don't lend aggressively, or if people save instead of spend, inflation stays muted. That's exactly what happened after 2008. The Federal Reserve expanded its balance sheet from under $1 trillion to over $4 trillion. Many predicted disaster. Instead, inflation stayed low for years. Why? Because most of the money stayed inside financial markets. It inflated assets, not groceries. But now let's escalate. Imagine a different situation. The government runs massive deficits. The central bank keeps buying bonds. Over time, government debt grows larger relative to the economy. In the United States, federal debt is over $30 trillion. In many countries, debt to GDP ratios exceed 100%. As debt grows, interest payments grow. If interest rates rise, governments must pay more to service that debt. That becomes politically painful, so pressure builds. Keep rates low. Keep buying bonds. Keep liquidity flowing. This is where the hidden mechanism appears. Money printing is not about physical currency. It's about suppressing borrowing costs. When a central bank buys bonds, bond prices go up. When bond prices go up, yields go down. Lower yields mean lower interest costs for the government. In other words, money creation quietly finances deficits at cheaper rates. It's elegant and slightly absurd. The government spends more than it earns. It issues debt. The central bank creates reserves to buy that debt. And the cycle continues. On paper, it looks sustainable. Until confidence shifts. Because here's the math most people ignore. If a country keeps expanding money supply much faster than its real economic output, eventually more money chases the same amount of goods. That's when inflation moves from asset prices into everyday life. In 2020, central banks printed at historic speed. Governments sent stimulus checks directly to households. Savings spiked. Demand rebounded fast. Supply chains were constrained. This time, the money reached the real economy. Inflation surged, not because of a single press conference, but because reserves turned into deposits, deposits turned into spending, and spending hit limited supply. The quiet plumbing spilled into the streets. Now think bigger. When a country prints money aggressively, its currency can weaken. If investors believe the money supply will keep expanding, they demand higher returns or move capital elsewhere. A weaker currency makes imports more expensive. That feeds inflation again. So the central bank faces a dilemma. Print to support growth and debt sustainability, or tighten policy, raise rates, and risk recession. Every modern central bank lives inside that tension. And here's the irony. Most money creation today is not done by governments or central banks directly. It's done by commercial banks when they issue loans. When you take a mortgage, the bank doesn't transfer existing money from someone else's savings account. It creates a deposit in your name. That's new money. So when people shout, "Stop printing money," they're usually looking at the wrong machine. The majority of money is created when banks lend during economic booms. Central banks mainly steer the cost of that process. Now zoom out. Why does this matter right now? Because global debt levels are higher than at any point in modern history. Governments have become structurally dependent on low rates. Financial markets expect central bank support during stress. If inflation returns, central banks must choose stability of prices or stability of markets. They can't perfectly guarantee both. And if they keep expanding balance sheets indefinitely, the long-term risk is not instant collapse. It's gradual erosion. Currency slowly losing purchasing power. Asset bubbles growing larger. Wealth gaps widening. All without a single dramatic headline. So the next time someone says, "The government is printing money," remember this. It's not trucks of cash. It's a quiet accounting entry. It's bond markets being absorbed. It's interest rates being shaped. It's power being exercised through balance sheets. And the real question isn't whether money is being printed. The real question is this: at what point does creating money to stabilize the system start? Quietly destabilizing it instead, because that line doesn't announce itself. It moves. Slowly. Until one day, everyone realizes it moved too far.